Almost all countries in the world are in debt. A country with a large economy like the United States now has a debt exceeding $38 trillion, which represents the highest debt in its history. The European Union carries approximately $14 trillion in debt, while Japan holds nearly $9 trillion. Even oil and gold-rich Saudi Arabia or leading export countries such as Germany and China have borrowed large amounts. However, a fundamental paradox emerges here. If everyone is in debt, who is the creditor or creditors? When we look at the history of finance, nothing is as simple as it seems in this field where money, power, and history are intertwined. Because debt is not merely a burden, it is a system that forms the foundation of the modern world. Wars, economic crises, periods of growth, and periods of collapse are all built upon this invisible debt system. When the chain of creditors is examined deeply enough, the following truth emerges. The world is not indebted to a particular side, but to itself. However, this does not mean that everyone benefits equally. Today, total global debt has exceeded $315 trillion, a figure that is nearly 3 times the size of the world economy. When we trace the origins of this system, we see that the concept of national debt did not emerge in modern financial centers, but in times of war. In 1694, while England was at war with France, it had exhausted its gold reserves. As a result, the king borrowed money from merchants and in return promised interest payments guaranteed by future tax revenues. To manage this system, the Bank of England was established. This development was revolutionary because it allowed states to spend money they did not yet possess. In return, lenders received the government's promise, something that could be bought and sold as a commitment. This marked the emergence of government bonds and the beginning of the modern financial system. Over time, this model spread to other countries. France adopted the system, the Netherlands improved it, and the newly established United States used this method both to finance its independence struggle and to expand. Thus, national debt ceased to be a sign of weakness and became a measure of credibility. The ability to borrow also began to represent the ability to govern. Wars were no longer fought only on battlefields, but also on balance sheets. Today, debt has effectively become the most widespread product of the global system. Every 100 days, global debt increases by approximately $1 trillion. In this system, every country is in debt, every bank lends, and every individual is both a debtor and, indirectly, a creditor. For example, about half of the United States debt is held by investors, most of whom are American. Banks, pension funds, insurance companies, and the central bank hold a significant portion of this debt. A considerable part of the remaining portion is held by foreign countries such as Japan and China. However, contrary to popular belief, only a small portion of U.S. debt belongs to China. In other words, the country is largely indebted to itself. This situation is not unique to the United States. It reflects the general functioning of the global system. Countries lend to one another, these debts are transferred to other countries, and the system continuously moves in a cycle. Every country holds another country's debt instruments, and every financial commitment is backed by another commitment. One of the most critical components of this structure is the markets. Behind government bonds are hedge funds, pension funds, central banks, and large investors. These actors determine which countries can borrow at low cost and which must pay high interest. When confidence is shaken, currencies may lose value, governments may change, and economies can rapidly reshape. Central banks are among the most powerful actors in this system. They do not only manage debt, but also expand the system by creating new money. When they purchase bonds, they generate new money in return. Therefore, every unit of currency in circulation corresponds to debt somewhere else. There is no monetary system completely independent of debt. This structure has stood for many years on trust. However, when trust is damaged, the system becomes fragile. The debt crisis in Greece in 2010, Argentina's recurring defaults, and the economic collapse in Sri Lanka are concrete examples of this. The system restarts after every crisis. Old debts are restructured and new ones are created. Because in the modern economy, debt is designed not to be fully repaid, but to be continuously rolled over. States do not aim to eliminate their debt, but to refinance it. This process is called refinancing. In this system, what truly matters is not the debt itself, but the interest. The global economy largely depends on this flow of interest. Major economies do not plan to fully pay off their debts. Instead, they sustain. The system restarts after every crisis. Old debts are restructured and new ones are created. Because in the modern economy, debt is designed not to be fully repaid, but to be continuously rolled over. States do not aim to eliminate their debt, but to refinance it. This process is called refinancing. In this system, what truly matters is not the debt itself, but the interest. The global economy largely depends on this flow of interest. Major economies do not plan to fully pay off their debts. Instead, they sustain the system by constantly renewing them. Investors also prefer the continuation of this cycle rather than retrieving their money because government debt is considered one of the safest investment instruments. In fact, if all debts were suddenly repaid, the financial system could experience a severe collapse. For this reason, governments prefer to increase debt in a controlled manner rather than eliminate it entirely. In this sense, debt has become a mechanism that ensures the continuity of the modern economic system. The goal of eliminating debt, often expressed in political discourse, is usually unrealistic. The real aim is not to remove debt but to make it sustainable, because the continuation of the system depends on trust in these debts. When trust disappears, economic balance is also disrupted. At this point, another important reality emerges. This system does not benefit everyone equally. Interest payments generally flow from the lower segments of society to the upper segments. In other words, debt creates a transfer of resources not only between countries, but also between social classes. Therefore, as global debt increases, inequality also tends to rise. As a result, creditors and debtors are two complementary parts of the same system. However, the sustainability of the system depends on the continuous creation of new debt. When this cycle is disrupted, the question, who is the creditor, gains a more concrete and personal meaning. At the highest level, there is no single responsible party. Neither a specific country nor a single institution is at the center of this system. The modern financial system consists of a complex structure formed jointly by states, banks, investors, and individuals. Today, debt has effectively become money itself. The line between debtor and creditor has become increasingly blurred. While in the past debt meant dependency, today it is seen as one of the fundamental elements of economic balance. However, when this balance is disrupted, one truth remains unchanged. Debt is not a promise that can be sustained forever.